Morning or good evening. Welcome to the Market Mondays webinar. My name is Kyle Rodder. I'm with Danny Haythorne. We're both market analysts at Capital.com. Good morning, Danny. How you going?
Good morning, Carl. Good morning, everyone. Welcome back to another week. I think, let's get the risk warning out of the way, and then we can start with everything that's been going on because it was definitely a volatile week last week, wasn't it, Kyle?
Yeah, been a volatile week, been a volatile sort of 3 weeks, and I think that could probably persist for another couple. Well, here's hoping anyway, because there's lots of opportunities out there. But like you said, risk warning. Just to say very quickly that nothing that you hear here is of a personal nature. All the information is general only. It doesn't take into consideration anybody's personal circumstances. Obviously, CFDs are risky products, so consider your risk profile and seek out financial advice if you feel like you require it. Um, Danny, also from your perspective.
Yeah, just that. Just be aware of the risk associated with the products that we offer at Capital.com, which for those of you in the UK also are spread bets. And again, similar risk profile to CFDs. Just be aware of the risk. And as Carl said, this is just general market information and commentary, not to be taken as personal investment advice.
Indeed. So we'll just run through quickly just perhaps some of the things that are going on in the markets at the moment. Obviously, Fed uncertainty, US earnings season. This week's going to be fairly light in terms of economic data relative to the last few weeks, where obviously earnings and macroeconomic data and macroeconomic developments, I really should say, has probably been a little bit greater, especially as we're slowly getting the backlog of economic figures from the United States sort of filtering through, although in a very staggered fashion and incomplete fashion. And then, Danny, you can maybe drive us forward a little bit with this one, but we've obviously got the UK budget update coming through, so that could be a pretty significant driver of at least volatility in the pound and the FTSE. But maybe let's start with just a discussion about what is going on at the moment in the markets, and I'll try and get the chart up if I can, just because I feel like it really illustrates the story rather well. And this is just in relation to what's actually driving things right now when it comes to global markets. I've been showing this far and wide because I think it tells a story. This is effectively the expression of interest rate uncertainty in the United States right now versus US equities. If people aren't acquainted with the MOVE index, it's often called the VIX of the bond market. Amongst other things, the bond market obviously is driven by monetary policy and monetary policy uncertainty in this instance, amongst other things as well. But what you can kind of see here at the moment is that the MOVE index, which I've got here inverted, so it's upside down, basically
I'm not
bottomed.
sure we can see the chart, Kyle.
Ah, you can't
Uh,
see the chart. That's annoying. Hang on. Let's see if I can get
so
this.
viewers are aware of what we're showing them.
Ah, sorry. Let me can you see my as I
Yeah,
toggle
we can
through this
see.
now? All right, let's see how
Yeah.
we go here. I'll try and create this chart if I can't anyway. But effectively, I'll explain it as I'm getting it up. The MOVE index is the VIX of the bond market, and amongst other things, it is a reflection of uncertainty regarding monetary policy or the outlook for monetary policy. And if you do um, take a look at the way that it has behaved, here we go. Still got all my drawings up. If you do overlay it with something like the Nasdaq, you could do the S&P 500 as well, but we'll go the Nasdaq in this particular instance, which is here. New price scale, 10% price scale. Let's go new price scale. You can kind of see that the MOVE index, again, being an expression of interest rate uncertainty, bottomed at the same time that the Nasdaq or the S&P 500 peaked. And incidentally, that was around the time of the last US Federal Reserve decision, which was when the now infamous line that a December rate cut from the US Federal Reserve is not a foregone conclusion was delivered. And since then, we've seen the dynamic where markets have not only priced out the number of rate cuts going forward into next year, also priced out a high degree of, well, priced out some probability of a rate cut from the Fed at the margins. That swung quite a lot. All of that has just contributed to the kind of sell-off that we've seen in equities, and I would argue has been the primary, not the only, but primary driver of market volatility from here. So that's kind of the story at the moment as I see it, Danny. And as you can see, we did get some comments from Christopher Waller on Friday that were a little bit more dovish and boosted the odds of a rate cut, as well as that jobs data, I should say, on Thursday. The markets moved from the lows in terms of that December Fed Fund futures contract to sort of imply, probably what was at the time a sort of 30% chance of a rate cut going to that jobs release to, well, it was up to about 40, 50, now it's back to sort of 70% or so. But really, I think in my telling of the story right now is that things are driven by uncertainty around monetary policy, and that until we either get enough data to paint a clear picture on what the Fed's going to do, especially in December, but into 2026 and beyond, or in the absence of data, which is likely because of what's happened with the US government shutdown and the fact we won't get October jobs data, we won't get a lot of inflation data as well, is that it won't be perhaps until that next Fed meeting, that final Fed meeting of the year, that this kind of volatility we've seen over the last few weeks eases.
It's interesting because there was a lot riding on last week in terms of, sorry, determining momentum and key drivers in the market. We had two key events, which, as you mentioned, was the US jobs data, delayed jobs data for September, and the Nvidia results. Now, I'm sure we'll talk about Nvidia and AI in just a second, but interestingly enough, Nvidia, which was probably thought to be the one that was going to rescue some of that risk aversion in markets, wasn't enough actually. And I mean, the data was great, the forward guidance was great, but it wasn't enough to kind of suffocate those concerns about the AI overinvestment, the AI boom, how much longer, can these hyperscalers continue to deliver results? What's going to happen when Nvidia faces increased competition, which is expected to happen at some point down the line. So all of that, I think, expectation that Nvidia was kind of going to cure some of that uncertainty didn't really pan out, and we saw actually some wild swings in the market on the Thursday after the data came out late on Wednesday. And interestingly enough, the US jobs data, which was expected to maybe show again a little bit of a weakening in the labor market, continuation of that jobs data that we saw in summer, which started to show cracks in the US jobs market. Interestingly enough, the US jobs data for September was actually pretty resilient as well. I mean, there was a little bit of a wobble on the unemployment rate, ticking up unexpectedly to 4.4%, but the participation rate also increased. You could see a little bit maybe of that attributed. But overall, the NFP headline data, so the jobs added both in the private and government sector was good. Wages creeped up once again, or was stronger than expected. So yeah, overall the reading was pretty resilient, but then markets actually priced in a higher chance of the Federal Reserve cutting rates in December after the data, which kind of seemed to be a little bit of a lost correlation there. So I think last week, there was a lot riding on that. We didn't get any sense of clarity, I think, from that. As you said, Friday culminated with that commentary from the Federal Reserve that kind of did more, I think, than markets were expecting, when we saw Fed Williams kind of saying that in his view, the Fed can still cut rates in December, given that the policy remains mildly restrictive. So I think that's what saw most of the moves on Friday, and that's why we saw a little bit of that rebound in sentiment. Now, we have to note that he seems to be a little bit of an outlier right now. We've seen other commentary from other Fed speakers kind of support and back the notion that maybe December is a month to wait and see and delay that rate cut into the year. But nonetheless, markets are currently clinging, clutching at straws and whatever they can. And that commentary from Fed Williams was definitely enough to revive some of that risk appetite. Now, heading into this week, we actually saw commentary from the BLS, so the government, the one who releases the government data, announcing that in fact the October CPI data is cancelled and the November CPI data will not be released until after the Fed meeting at the beginning of December. So that leaves markets once again clutching at straws, wanting to know more, but not really seeing much on the calendar that's going to help decide. As you were saying, Kyle, maybe it's a case of waiting until the actual meeting to see any more insight into how the economy has been performing. However, this week, it's not the busiest week, but we do have a few readings that could catch investors' eyes. And I think specifically after that they've officially announced that the October CPI will not be released and that November CPI will not offer any guidance before the Fed meeting. We do have some delayed PCE data coming out this week in the US, which could, again, maybe catch investors' attention, maybe drive a little bit more volatility. We also have retail sales, we have GDP data as well from the US. Again, maybe not the most exciting data, maybe investors will take it again, it's delayed data. How much realistically is it going to tell us? But I think at a time when there's nothing else out there and investors definitely want to know more, they're trying to fight to find a direction as we're seeing in markets. I think we could see, interestingly, some volatility stemming from the data this week.
Yeah, I mean, I suppose it'll provide us with some kind of partial picture of what's going on. I think, with the PCE, it may not be released in the end as well, which could be a little bit of a pain in the, I was going to use a swear word, pain in the backside, for market participants, just because really, I mean, what the Fed's trying to do here is, give itself as much optionality as possible going into this December decision because it's worried about the inflationary risks coming down the pipeline. And, I think interestingly enough, the jobs data was pretty much as good as you could kind of hope for, in the sense that it showed an increase and obviously it was stale, but it showed an increase in employment, which obviously comes through from the business survey, but then also, or the household survey, but then also the unemployment rate ticked higher a little bit as well, which, sort of indicated that the Fed has the ability to sort of cut rates because the labor market might have at the margins a little bit more spare capacity than previously thought. But, effectively, the problem is now is that everybody is flying blind. And then I think, the word that's been thrown around a lot in the markets is that there is a sort of a fog at the moment because there's just a lack of information. So it's a question of, what is the path of least regret for the Fed going forward? Do they not cut interest rates in the absence of good, solid data, because they're worried about inflationary risks and don't want to risk stoking that in the absence of information about what inflation is actually doing? Or are they worried about the labor market, and fearful that, maybe there is more deterioration going on there that, we're not getting a good sense of because we're not getting this information, and therefore they should have sort of a precautionary insurance cut. Again, I suspect that, more than just what the Fed will do, it's the distribution of risks now that have become much wider over the last 3 or 4 weeks, which inherently manifests in higher volatility because that's effectively what volatility is. It's about an uncertainty about a particular outcome and a wider distribution of risks. And as a result, we've got these big swings in the rates markets. This December Fed funds futures contract has gone from implying in the space of 3 or 4 days, a 25% chance of a rate cut all the way back up to 70% now, and it's swung in between those levels. Again, that's the kind of thing that manifests in higher volatility. Higher volatility inherently means less risk appetite, and obviously the kind of volatility that we've seen in the market. So it is the prospect here that unless we start to get a very clear indication from the Fed on what it plans to do going forward, and it can kind of shrink those distribution of risks, then the kind of price action that we've seen, this bearishness in the market that we've seen for the last 3 weeks could persist. I don't know, Dan, just because we have touched on earnings very quickly, it's basically all but the end of the earnings season. I thought we'd just take like a very, very cursory look at just what happened in terms of earnings growth for the quarter, because I always love this fact set. I know we've spoken about it before. We've pushed people in the direction of looking at this fact set report that comes out every Friday. But this is my favorite chart. They don't release it every week, but my favorite chart when it comes to the reporting period at the moment, which contrasts the Magnificent Seven earnings with the S&P 493. And you can see here that actually the earnings growth exceeded expectations from Magnificent Seven companies once again, because they always do. But they didn't smash it quite as much as previous quarters, which were, in Q2 and Q1 we sort of had estimates that the cohort would post earnings growth of about 15%, mid-teens or so, and would end up sort of posting somewhere closer to 30%. Now it's sort of still a beat, but a smaller margin. And while you still have a situation where the broader S&P 500 is trailing behind the pack a little bit, but still with double-digit earnings growth. So, I mean, it's sort of looking at around, we're not fully through the earnings season yet, but we've done pretty much 95% of the earnings period. And you can see here that, yeah, pretty much we're looking at sort of, well into the double-digit earnings growth across the S&P 500, which is, really, really solid. And if you do look at pretty much the forecast going forward into next year, the markets are expecting earnings growth. And this could be a sort of poison chalice to some extent because markets are projecting that the Magnificent Seven will continue to grow earnings on average at about 20% every single quarter, and that the S&P 500 earnings will be in excess of 10% on aggregate. So a lot of optimism actually still baked into the market, which says that again there's potential strength perhaps if the volatility in the rates market subside and investors can go back to just focusing on what they're willing to pay for earnings, but also the risk of downside disappointment if these earnings perhaps don't materialize as currently priced in.
Yeah, let's flip it over now to the UK because we did mention we'd have the UK autumn budget, and do have a question on the FTSE. So if you want to bring up the chart of the FTSE, and we'll look at
Sure.
it in just a second. But essentially, there's a lot of focus on this budget, basically because the UK continues to face a challenging fiscal environment. There's no doubt over that. We've seen economic growth still very sluggish in the UK. Inflation remains elevated. It has returned to a disinflation trend in the last month, but nonetheless still remains elevated well above that 2% target from the Bank of England. And public sector borrowing is very high. Now, recent data suggests that we once again there is an additional gap in the public sector finances, roughly about £30 billion or so, which is something that the Chancellor is going to have to try and cover with the budget. Now, one of the key things is, and a lot of focus has been put to this, is the Labour government's manifesto that they are not going to increase income tax, national insurance for working households, any VAT. Or raise, I think, the key line of corporation tax. So that's kind of been their selling point, and that's what they've been trying to deliver in the last year or so, since the last autumn budget, which was the first one of the new government. What does this mean for this week, for this budget? Essentially, it means that Chancellor Reeves is going to have to try and shore up additional public finances without trying to increase some of these key tax rates that they've been talking about for the last year. So maybe it's not a case of looking whether tax rises happen, but more about where are they distributed and where are they happening. Things like property tax, wealth tax, certain tax reliefs for certain sectors. So I don't think it's going to be a full-blown tax increase, and I think that the Labour government is definitely going to try and avoid that when it comes to, as I said, national insurance, when it comes to income tax. They're probably going to try and avoid that because that is essentially their USP, their selling point. But they're likely going to increase taxes elsewhere because they're going to have to. They need to plug this gap that they have. Now, I remember commentary from Reeves in the last few weeks actually saying that they'd found a way to plug this gap without increasing taxes. But I remain highly doubtful that is as easy as it's been said, and I'm sure there's going to be some sort of increase along the lines. It's just going to be a case of finding where. So there's going to be a lot of focus on that, and of course the pound and the FTSE are going to be key markets to watch out for this week when the budget is released on Wednesday, the 26th. So yeah, when it comes to the FTSE, valuations in the UK remain attractive compared to international peers. However, there are concerns about the outlook of the UK economy. As I said, growth remains sluggish, inflation remains elevated. That famous stagflation word, maybe not as prominent as in previous months, but definitely something to be concerned about, with economic growth still remaining tepid, and demand from consumers specifically remaining very subdued. So there's a lot of focus on the outlook there. When it comes to the volatility and the momentum we've seen in the last few days, again, the FTSE has been following international markets, as you can see there very clearly. That significant sell-off that we've seen following the general risk-off sentiment that we've seen in global markets following all of this uncertainty that we've been talking about for the last 20 minutes or so. We did see Europe overtaking the US at the beginning of November. We kind of did have this uncertainty picture in the US that hadn't yet spilled over. So we saw the likes of the DAX, the Stock 600, the FTSE actually overtaking the momentum and seeing some strong moves. You can see the FTSE there almost breaking out towards that 10,000 level, which is a key significant level for the index. However, the uncertainty caught up and we did see some of these stocks heavily sold off. As I said, valuations remain more attractive than elsewhere, but concerns about the outlook have limited the attraction of UK stocks. So, yeah, it's just a case of how is this budget going to fit into sentiment around UK assets? And I think that's going to be a key driver, as I said, both with the pound, the gilt market, as we remember from previous governments. I believe it was 2022 when we saw that gilt market meltdown. With the Liz Truss government essentially pledging money to spend that the government didn't have. So markets are very cautious heading into these announcements. I think Chancellor Reeves is well aware about the bond market meltdown and she's going to do everything capable to try and avoid that. She did that pretty well in the last budget, I do have to say. There was a very subdued and calm bond market after that announcement. So just watch out for any, I guess, inconsistencies or any concerns that may creep up in the bond market on the back of this announcement. As I said, watch out for any tax increases, maybe not so much to income tax and national insurance tax, but more to do with wealth and other specific sectors.
Yeah, totally. And obviously you're more in the weeds than me with this sort of stuff, Danny, but obviously you'll be looking for that kind of potentially toxic mix of, a weaker stock market, a weaker bond market, and a weaker currency market if they
Yeah.
don't hit the right note when it comes to fiscal settings. So once a watch potentially, and that could conceivably, although it's a low probability risk, could conceivably spill into global markets too, incidentally, which will be around Thanksgiving and the Thanksgiving Day holiday, which will mean that liquidity is a bit thinner, movements might be a little bit more pronounced. Danny, because we really don't have that much substantial on this week outside of obviously the budget update here, which is probably going to be a little bit more of a local concern, and then the smattering of sort of US economic data, which won't give us that much substantial. Maybe we'll go into the questions, and then maybe we can talk through other markets if people want us to discuss them. I just did see that there was one question here about Japan and the stimulus package lowering gains in the USD JPY. And I think this is a really good question because it perhaps highlights one, the situation that Japan is in, and two, why more fiscal stimulus isn't always going to be good for a currency. And in this particular instance in Japan, what we've seen as the prospect of more stimulus has increased, and this is something that the market's been pricing in since the election of Takaichi. The yen has depreciated on the basis that it is contributing to the expectations of lower real yields, and perhaps a degree that a lot of this stimulus will result in just simply higher inflation and therefore currency debasement, that we've seen the yen actually drop and continue to drop. And what that means is that if we continue to see this stimulus package go through, and that the new government in Japan, which is increasing stimulus really on the basis that it wants to shore up domestic manufacturing capacity and increase defense capacity as well, both being for reasons of kind of economic statecraft rather than rational economic policy, that will continue to put downward pressure on the yen in the absence of the Bank of Japan that steps in to try and offset the inflationary impacts of all of that fiscal stimulus. So what I would just say when it comes to the Japanese situation, when it comes to fiscal stimulus, at the moment we're not seeing any kind of rumblings of a currency crisis or anything like that, like we are in the UK, which could manifest in, again, a meaningful sell-off in Japanese government bonds and stocks and the yen at the same time. But what we are seeing is, while the Nikkei, melting upwards because of the prospect of just a lot of stimulus, a lot of government spending, but also a Japanese yen that's depreciating, mostly because the Bank of Japan is, I would argue, a little bit cowardly in trying to rein in what is above target inflation already in Japan. And incidentally, I think we get the Tokyo Core CPI released on Friday, which will tell us whether inflation in Japan remains above target and potentially even moving away from target, which has been the recent trend. And once more, the reason why the yen has depreciated despite this, increased talk of fiscal stimulus. So keep an eye out for that one because the yen is a fascinating trade. Notwithstanding too that there has been some sort of verbal interventions in the last week or so that did very briefly, and we'll just get the chart up just for illustrative purposes. We did see that kind of move happen because of some talk there about possible intervention in the end, which can't be ruled out either because we are getting to levels now, which we've only tested on a couple of occasions in the last however many years. I think it was 30 years or something like that, above 160. So that's going to be an interesting one to watch. Daniel, I don't know if you want to tackle the next question or not.
Oh, I was just going to say, if we want to pop up gold quickly,
Yeah.
because gold is always a very interesting chart. And it's definitely very interesting right now. And yeah, so we always have questions on this. But interestingly enough, in the same way that Bitcoin has definitely been a proxy for risk appetite in, especially the last week. I mean, the significant sell-off we've seen in Bitcoin has definitely talked about, the mental state of the market. I think gold also definitely gives clues as to the positioning right now around the Fed uncertainty. And as we talked about earlier, the chart showing about 71% chance now of a cut in December. Very, very tentative. And the reason for that is we're not seeing any follow through in gold. And I think that's where you get a lack of conviction that that may actually happen. I think that is just a genuine reaction to Fed Williams' comments that we saw on Friday, which kind of gave dovish hopefuls a little bit of respite and something to grab onto. But realistically, we can see here gold has kind of steadied around that 4,050, 4,060 mark for the last few sessions, clearly lacking a sense of direction here. And I think, again, it just talks about how tentative that market is, how much uncertainty there is, and how much of a lack of conviction there is as to what exactly is going to happen in the next few weeks as we head into that FOMC meeting. You talked about Carl earlier. The Fed can take this both ways and have significant backing and significant selling points for both of them, whether it's keeping rates unchanged because of concerns about inflation and wanting to know more about data, or cutting rates as a precautionary measure, and focusing more on the labor market. It can go both ways and it can be justified both ways. And I think that's clearly where markets' heads are right now. And for me, the picture that we're seeing in gold clearly justifies that. And very much, the pricing right now is very tentative. There is a lack of conviction, that the decision can go either way until we get more data, which we've said, either data or commentary that will skew the probabilities in either direction. It does seem like gold remains pretty much subdued around these levels, just trying to find direction. We're kind of seeing a little bit of hedging from certain markets, but also not enough risk off sentiment to kind of pile into gold.
Yeah, I was sort of looking at this setup a couple of weeks ago where it looked kind of maybe a bit cup and handly, but that doesn't seem to be sort of playing out necessarily. But there's definitely that degree of consolidation going on. And I think it was sort of interesting, we talk about the fiscal situation across the world, that, the reason why gold was running up so aggressively was that there was that expectation that there'd be a lot of fiscal stimulus, from the States, from Germany, from Japan, obviously not from the UK because they're in a sort of a crisis situation, have to pull back. But there was that dynamic going on at the same time that central banks were, seemingly turning a blind eye to inflationary risks. The Bank of Japan, for example, is still seemingly doing that. The reason why the Fed has pivoted over the last sort of month or so is because it obviously has acknowledged that there could be some inflation coming down the pipeline. And what I was sort of calling this sort of run it hot trade, where just policy was loose from both the fiscal and monetary perspective, the expectations of that have been unwound a little bit. So that momentum in gold has sort of shut down. But you can sort of see here that it's that indecision, like you spoke about, Danny, about where we go through next, albeit within this kind of, sort of broader uptrend. So, we'll keep an eye out for that sort of that Fed setup. Maybe just because I do see there's a question here very, very briefly, and I'll only answer it very quickly just because it's not something that's generally very tradable directly with our platform, but just the relationship between short bonds and long bonds, which is to sort of say that if you do look at sort of the 30-year yields, that's a really good barometer at the moment, I think, of current fiscal settings and the sustainability of them, and then also the upside inflationary risks in the long term that the markets have to discount. So, what we are often seeing is that, as short rates come down rather than long rates coming down as well, it's normally leading to an uplift at the back end. And again, that's sort of a manifestation of the level of government stimulus coming through at a time of, again, high inflation already, as well as, the fears around the sustainability of fiscal settings, more broadly speaking. So a bit of a barometer there more than anything else. Something that if you're a bit more macro focused and long-term focused, there might be sort of a little bit more signal and trading signal. But in the short term, notwithstanding, a trust-like event that could happen this week, but I'm sure it won't. Perhaps not that relevant in the very, very short term. But let's, I suppose, wrap it up there, actually, Danny. I think that's the final
Yeah.
question we had, and we're at nine. Well, in London, we're at 9:31, so we'll call it a week.
Yep. It's been, as I said, there's a lot to watch out for. Maybe not the busiest calendar in terms of data and earnings, but definitely a lot of expectations that something will happen that will give markets kind of a direction. In the absence, it kind of just seems like the path of least resistance goes. It's going to be interesting for equities whether this week it's to the downside or to the upside. Given that they're trying to recover a bit of momentum after Fed Williams's comments on Friday. So yeah, it's going to be a very interesting week. See what drives that volatility and momentum.
Indeed. Well, Danny, same time, same place next week. In the meantime, have a great week.
Indeed. Bye, guys.
See you around.